Hi everybody, this is Phil Holoka from Complete Captive Management Services, and today we're going to talk about the exit strategy. Now, I understand that most people don't want to think about how do you exit a strategy before you get into it, but with a captive insurance arrangement, you really have to have some basis of understanding of what certain triggers are going to motivate someone to divest themselves from a captive insurance arrangement. So the one key word that you really should focus on is the word invest. I'm a captive manager and I don't look at captive insurance any differently than I would if I were to invest in a publicly traded company, aka buy a stock on the New York Stock Exchange or on the NASDAQ. So I suggest to people that you need to look at this as an investment, okay? So there are 3 steps that I like to bring attention to. The first one is, before you invest, ask the captive manager this. Ownership. Will my business own the captive, or am I just leasing space in someone else's captive? Now, if it's a group captive, I may be a mutual owner of the captive. So I'm still an owner, but I'm diluted with the other participants in the group, which is okay. Now, with ownership, you have to ask the next question, am I governing the captive, or do I have control of the captive? These labels are not interchangeable. Governance is when you guide or suggest or recommend to the decision makers, and control is when you inform or you are the decision makers. Okay? Now, if you have control, you should also have hire and fire ability with service providers and carriers. Keep in mind, a service provider is a captive manager, a captive program manager. These two are not always the same. The actuary, the auditor, and the carrier. If you don't have full control, you will not be able to discharge the captive manager who may not be performing to the standards of the mutual members. Okay? It's important. If you have control and you have access and hire fire ability to the service providers, what about transparency? Is it full transparency or is it partial transparency? I'm really big on full transparency, and if you're joining a group captive that is fronted by a commercial carrier, you need to see the bordereau report. That's where the secrets are hidden. If you don't see this, you don't have full transparency. So these are just a couple of things that you should take in consideration before you invest in a captive solution. The second one, how do you measure your success? Are you going to go into this with hey, my current PEPM is $500. I'm happy if I can keep my PEPM under 10% year over year. Because I know that if I'm in the fully insured market, my premiums go up 15%. So if I can keep my renewals below 10%, I'm happy camper. And what if I now have the ability to control risk? Well, if I'm in a fully insured program, I may not have any control or interest in controlling the risk of my staff or my business. Okay? So maybe that's a litmus test or a milestone that you're going to have to self-govern. What about you're just simply interested in reducing your employee costs of health insurance because you're in a completely competitive market, or you just want to increase the access of care? Who knows? So you got to have milestones. You can't measure your success in a captive unless you have defined milestones. The third thing is, every time I buy a stock, I have a target sales price. Well, you should have a target sell price when you're in a captive solution also. So the only way to legitimize the value of your captive's premium pricing and other factors is you got to go to the market. Now, this is a double-edged sword. If you go to the market, I'm a captive manager, and I know that an eager commercial, fully insured market who is eager to pick up your business is going to underprice you the first year. So in other words, if our captive priced you at $100, the fully insured market who is eager to get your business may come in at $90. So you as the buyer have to understand there's going to be a certain element that the carrier is going to want to buy your business. This is also a way to anger your fellow risk pool participants, because when employers or insureds go in and out of a captive, that destabilizes the actual risk pool, and it's not good. So if you're doing this, you may come out for a year and say, oh, I'll just go in next year when my risk gets better. You may not be welcome in that captive after you leave. So that's you need to consider that. But you should really go to the market just to test what your premiums could be in the market and just use that as a basis for your decision making. Are there any holdbacks? I will tell you unequivocally, most group captives will say, if you join in 2023 and you earned $50,000 of underwriting profits and you leave for the 2024 renewal, you're going to forfeit those $50,000 underwriting profits. So you have to understand there could be collateral or underwriting profits that have been earned that are now held back because you left the program. Okay? 3 things you need to take in consideration. Next week, we're going to talk about even more granular, when is it time and what triggers you should look at when you want to exit a captive insurance arrangement. Until then, we'll talk to you next week. Bye now.